Many beginners in the stock market ask a very common question. Do stock charts really work, or are they just lines drawn by traders to confuse others? This doubt is natural, especially when you hear people say that the market is unpredictable, manipulated, or driven purely by news and luck. If stock prices are influenced by big institutions, emotions, and global events, then how can simple charts with lines, patterns, and indicators possibly work? Interestingly, stock charts continue to work even for people who don't believe in them. This fact alone makes charts one of the most fascinating tools in the financial world. Stock charts are not magical tools that predict the future with 100% accuracy. Instead, they are visual representations of human behavior. Every candle, every line, and every pattern on a chart represents decisions made by millions of buyers and sellers. Fear, greed, hope, panic, and confidence are all silently recorded in price movements. Whether a trader believes in technical analysis or not, their buying or selling action still contributes to the chart. That is why charts remain effective. They reflect reality, not belief. Another reason charts work is because markets are driven by repetition. Human psychology has not changed for centuries. When prices rise too fast, people become greedy. When prices fall sharply, fear takes over. These emotional reactions repeat again and again, creating recognizable patterns on charts. Support, resistance, breakouts, and trends are simply the result of repeated human behavior. You don't need to believe in gravity for it to pull you down. Similarly, you don't need to believe in charts for them to reflect market psychology. Large institutional investors, hedge funds, and professional traders also use charts. They may combine them with fundamentals, algorithms, and data models, but price action remains central to decision-making. When big money reacts at certain price levels, those levels become visible on charts. Retail traders who read charts are not predicting the market. They are observing where money has already shown interest. This observation itself creates a self-reinforcing effect. In simple words, charts work not because they are perfect, but because they are widely used. When enough participants watch the same levels, patterns, and trends, the market reacts accordingly. Belief is optional. Participation is not. The moment you trade, you become part of the chart. That is why even skeptics unknowingly contribute to making stock charts work. At their core, stock charts are a map of collective human psychology. Every price movement represents a battle between buyers and sellers. When buyers dominate, prices move up. When sellers take control, prices fall. Charts simply record the outcome of this battle. The reason charts work even without belief is because psychology drives markets more than logic. Consider support and resistance levels. A support level forms when buyers repeatedly step in at a certain price. Resistance forms when sellers repeatedly sell near a price. Over time, traders remember these levels. When price approaches support, buyers feel confident again. When price nears resistance, sellers become active. This memory-based behavior happens whether traders consciously believe in technical analysis or not. It is a psychological response to past experiences. Charts also work because fear and greed are predictable. During an uptrend, people fear missing out, FOMO, so they buy higher, pushing prices further up. During a downtrend, fear of loss forces people to sell, pushing prices lower. These emotional cycles create trends that can be seen clearly on charts. Trend lines, moving averages, and channels are not magical indicators. They simply help visualize crowd behavior. Another powerful reason charts work is confirmation bias. Traders look for information that supports their decisions. When many traders see the same pattern like a breakout or double bottom, they act in similar ways. Their combined actions turn expectation into reality. Even if a trader claims not to believe in charts, they still react to price movements. News-driven spikes, or sudden drops, which are all reflected in charts. Importantly, charts do not predict exact outcomes. They provide probabilities. Professional traders don't ask, "Will this trade definitely work?" They ask, "Does this setup give me a higher probability than random chance?" Over many trades, small probability edges can create consistent results. This statistical nature of trading is another reason charts remain effective regardless of belief. In the stock market, price is the final truth. News can be misleading, opinions can be biased, but price shows what participants are actually doing with their money. Charts display this truth clearly. You may ignore them, criticize them, or doubt them, But as long as humans trade with emotions, charts will continue to work. One of the strongest reasons stock charts work is the concept of self-fulfilling prophecy. Breakouts, breakdowns, and trend reversals often occur simply because many traders are watching the same levels. For example, if thousands of traders see a stock breaking above a resistance level, they place buy orders. This sudden increase in demand pushes the price higher, confirming the breakout. This mechanism works whether traders believe in technical analysis or just react instinctively to price movement. Modern markets are dominated by automated systems that analyze price, volume, volatility, and trends. They respond to data. Their buying and selling actions further strengthen chart patterns. This makes charts even more relevant in today's market. When stop losses are placed below support or above resistance, they cluster in certain areas. This creates liquidity zones that are visible on charts. Again, belief is irrelevant, execution is what matters. Charts also simplify complexity. Instead of analyzing hundreds of variables, traders can observe how the market reacts. This efficiency is why charts have survived for decades. They work because they reflect behavior, expectations, and reactions at scale. The more participants rely on them, the more effective they become. In this sense, charts are not tools of belief. Many people think charts are only for short-term traders or intraday players. This is a misconception. Even long-term investors who focus on fundamentals use charts sometimes unknowingly. Timing entries, identifying trends, and avoiding bad phases are all chart-based decisions. For example, an investor may believe strongly in a company's fundamentals but still wait for the stock to show strength before buying. This strength is visible on charts through higher highs, higher lows, or breakouts. Similarly, investors often exit when a long-term trend breaks down. These decisions improve returns and reduce risk. Even if the investor claims not to believe in technical analysis, charts also help investors control emotions. Instead of reacting to daily news or rumors, charts provide structure. A clear trend or support level helps investors stay disciplined during volatility. This emotional control is one of the biggest advantages of chart analysis. Another reason charts work is that they adapt. Unlike fixed theories, charts evolve with market conditions. New patterns form, old ones fail, and traders adjust. This flexibility keeps charts relevant across different markets, timeframes, and asset classes. Importantly, charts do not replace thinking, they support it. The best traders combine charts with logic, risk management, and discipline. They understand that losses are part of the game. Charts don't eliminate losses, but they help manage them. Over time, this management leads to survival and growth. Whether you believe in charts or not, the market doesn't care. Price moves based on collective decisions. Charts simply record those decisions. Ignoring charts is like driving without looking at the road. You may still reach somewhere, but the risk is much higher. The ultimate reason stock charts work, even without belief, is simple. Humans don't change. Technology evolves, markets expand, and tools improve, but emotions remain the same. Fear, greed, hope, and regret drive decisions today just as they did decades ago. Charts capture these emotions in their purest form: price movement. Charts are not about predicting the future. They are about understanding the present. They show who is in control, where risk exists, and where opportunity may arise. Traders who respect charts are not worshiping them. They are reading the story written by the market. Belief is personal, but participation is universal. Every trade adds a new data point. Every reaction strengthens patterns. That is why charts continue to work across generations, cultures, and market conditions. For beginners, charts offer a structured way to learn. They teach patience, discipline, and probability. For professionals, charts provide efficiency and clarity. For skeptics, charts still work because skepticism does not stop price from moving. In the end, stock charts are not about faith. They are about behavior. And as long as humans trade with emotions, charts will remain one of the most powerful tools in the stock market.